Hello, my name is Melissa Skilliter, and I'm an attorney with the Low-Income Taxpayer Clinic, the LITC, at Southeastern Ohio Legal Services. Many homeowners are surprised to learn that their efforts to save their homes can have income tax consequences. This is because federal law considers canceled debt to be income. It's important to understand generally how the IRS deals with this type of income and what you can do to make sure that you don't trade a mortgage debt for a tax debt. When you receive money from a loan, it's not considered income because you have to pay it back. If circumstances change and you don't fully pay the debt, then the unpaid portion is normally income. I'll refer to that income as cancellation of debt income. Fortunately, there are several provisions that allow you to exclude that income, which means that you will not have to pay tax on it. Cancellation of debt income can result from any type of loan: credit cards, car loans, mortgages. It doesn't matter what type of loan it is, just that there's some portion of it that will not be repaid. The debt is considered to be canceled when there is an agreement that it will not be repaid, when the lender decides that they are not going to collect the debt, or when the debt can no longer be collected as a matter of law. So in the area of mortgages, you might see a cancellation of debt income if the lender agrees to reduce the principal of the loan, if there's a short sale where the lender agrees to accept less than is owed as payment in full, if the homeowner transfers the property to the lender as payment in full, or if the home is sold at share of sale and the lender is never able to collect the full amount of loan due. It's not important whether or not the homeowner keeps the home, just that they will not be able to pay the full amount of the loan. When a debt is canceled, the lender is required to issue a 1099-C to the borrower and to the IRS that states the amount of the loan that's been canceled. The 1099 comes in the mail in January or February in the year after the debt's been canceled, just as your W-2 does from your employer. For this reason, it's important to update your lender with your current address if you move out of the property. The borrower must report the cancellation to the IRS on their annual income tax return, but it doesn't mean that the cancellation will result in extra tax due to the IRS. It's very important to note that a borrower with a canceled debt will need to file a tax return for the year of the cancellation, even if they don't usually need to file a return. If you don't file a tax return, the IRS will assume that the entire cancellation is taxable, and eventually they'll send you a bill. There are two exclusions from income that usually apply to a home mortgage. An exclusion means that you won't have to pay tax on the part that can be excluded. The first is the qualified principal residence indebtedness exclusion. When the foreclosure mess started, Congress passed a special provision that allows homeowners to exclude canceled debt that was secured by their primary residence or the home where they live most of the time. The rule can be applied to cancellations that occur in years 2007 through 2013. It's possible that the law will be extended again, but at this point it's only through 2013. This rule helps many homeowners. You can exclude up to $2 million of canceled debt, or $1 million if you file married filing separately. The problem that many borrowers encounter is that you can't apply the exclusion to any funds that were used for expenses outside of the purchase, building, or substantial improvement of the home. If you refinanced your home and pulled money out to pay other debts, like credit cards, then this exclusion does not apply to the portion that went to other debts. The other exclusion that may apply is insolvency, which means that the value of all of your assets is lower than the amount of all of your debts. When you do this calculation, you include all assets, including retirement accounts, the home that is at issue, and all of your debts, including the mortgage debt. If you owe $100,000 and all of your assets are worth a total of $80,000, then you are $20,000 insolvent. In that case, you could exclude $20,000 of canceled debt income. The good news is that you compare these two exclusions, and many homeowners who lost their home because they could not afford to pay, or who gained a loan modification because they are experiencing financial hardship, won't face a large tax bill. In order to avoid such a bill, there are several steps that you should take. First, keep all of the documentation from your foreclosure, your short sale, or whatever transaction resulted in the cancellation. When you get a 1099 from your lender, keep that too. If you're expecting one and don't receive it, call your lender and ask them to send you one. Second, hire a tax professional to prepare your tax return. This may cost you a little bit of money, but it can save you thousands of dollars and a lot of headache. Find a real pro. For this type of issue, I would suggest finding a certified public accountant or a CPA. Filing a correct return with this issue requires some knowledge of the law and at least a little bit of thought. When you meet with the preparer, take all the documents you've collected, including the 1099-C. Once your taxes are prepared, if you end up with a large tax debt, get a second opinion. Our LITC assists taxpayers with tax debts, and sometimes we see these issues where the debt could have been excluded, but the tax preparer did not do it. Finally, if you have a tax debt from a cancellation of debt or any other issue, find your local LITC or another tax professional to help you address the debt. There are a lot of options, but most people bury their heads in the sand and hope it'll go away. These problems only get larger. In Ohio, you can call 1-866-529-6446 to be directed to your local legal aid program.